And we are officially live. Another episode of Shut Up and Invest. We appreciate you guys joining us. I got my man Jay Money in the house. What's up, boss?
What's going on, Kevin, man? How you doing?
Everything is blessed.
Same over here, man. I'm in Michigan today, so a little bit colder, no water, but still the same grind. So
I did notice the backdrop. It looks a little bit more. You got a jacket on, first of all.
yeah.
You you got the sniffles, so it just doesn't seem like you were in Puerto Rico.
Nah, man, my allergies are affecting me up here. It's just, I'm allergic to the cold, so I gotta get back to the motherland.
Listen, today, guys who are joining us, and if you're joining us for the very first time, welcome to our show. Here we basically break down all the different aspects of investing in the real estate game. Sometimes we even talk about different other return on investments and investment strategies that we do. Right now, today's show is about a big question between the differences of private money and hard money. There's some confusion. People use those terms different. And I'm going to tell you from my perspective as a private money or hard money lender how it's usually used, but I will give a disclaimer. That doesn't necessarily mean that the person you're speaking to is using it in the way we're going to break it down. And we'll kind of get into all that, the different specifics, different guidelines, negotiating tactics, how to raise money. We're going to get into all that today.
Definitely, yeah. I've been up here in Michigan since last Wednesday, and so literally pretty much every day I've been out raising private money, right? Talking to private lenders, right? Trying to secure, future lenders and just kind of solidifying, our current lenders, right? So a good topic. We get a lot of questions about private money, so let's kind of break into it.
Yeah, and the fact that you mentioned that is a good place to start. You want to build relationships with your lenders. You want to have at least, I would say, 2 or 3 go-to people, because my taste and my what we call credit box or guidelines is not going to fit every single possible deal. So if you have 2 or 3 different people, some of them may like certain deals that others do not. Some of them, their terms may be a little bit different. So I would say you don't want to have 20, because then you never really build a relationship with any of them. Unless you have 20 kind of like joint venture partners that are funding your deals and they just want a return on investment and you're raising money that way, that's different. And that's called private money. And that's kind of what we're going to get into today.
Yeah, another thing too, though, is like, you realize that, and I'm talking about private money because I'm here, meeting with private lenders. These are private individuals, who have, loan maybe 50,000, maybe 500,000, right? So these are just private individuals. Appreciate that. Thank you for that. Grandpa, wish that I am a grandpa now.
Right, that's what you're doing in Michigan. You became a grandpa, huh?
Yes, I did. Yeah, April 2nd. I'm my first grandson. So I'm officially in that club of a little bit more wisdom, I guess,
A little more wisdom and a lot more money needed to spoil the grandkids now.
Yeah, money. Private money. Need more private money. But one thing I'll say too is, a lot of lenders are different as far as like some private money lenders, they want to know everything you do, right? Like we have some that want to know every single detail to like marketing and everything else. Others just say, hey, what's my return, right? And then besides the return, they want to know you, right? They want to know more about you and trust you, right? So it depends, and there's a balance, like you have to have kind of we call it kind of a story, a quick story that when you meet with your lender, right, you give them a quick 1 to 2 minute story. You don't want to just dive deep into everything because some people they're gonna get lost, right? So you learn that the more and more you talk to people trying to raise funds.
Yeah. So I guess let's start off with what I define as private money versus hard money. So the term is used, a lot to describe any kind of money that is not the traditional money. So we're going to kind of give you a way to think about it. But even if you're having a conversation and someone says private money, they may be talking about hard money, and it may not be necessarily private. It may be what I call institutional money. So we would be considered hard money lenders, for example, myself, because I have institutional money, I have guidelines, I have a process, I do multiple loans. It's our business. This is what we do. So a lot of people would consider us hard money lenders. That doesn't mean that I don't do private money as well. So private money is more like, Bob, who's got $150,000 and he's willing to lend you the money and you guys come up with terms. And this isn't his business. This is just money that he has that he's willing to invest. He may have a lot of it. He may have a couple million, and he might be willing to do a couple deals with you. And you might, find him to be your funding person. That is kind of what we break down in the industry as like private money. People specifically that are interested in investing, but they're not institutionalized company that has, the standard operating procedures. This is what they do. They have guidelines. They lend money. This is more kind of like one-on-one relationship based. Whether they're doing one deal or they're going to do 50 deals for you, they're not necessarily your traditional hard money lenders that have a process. Is that kind of the same way you look at it?
Yeah, that's kind of the way, right? A hard money lender, usually you find them, right? They're usually they're usually licensed, right? They have a broker's license. They offer hard money terms, right? So like you said, it's your institutional money, right? So it's like your hedge funds that say, hey, Kevin, here's a loan program we have that we offer, and then Kevin can, shop that program out to other buyers. Whereas the private lenders are private lender. That this could be your aunt, this could be your, next door neighbor, this could be, an in-law, it could be a friend, it could be your doctor, your dentist, right? Those are private lenders who their money's not into a fund that's out there going. They're just saying, hey, I got $100,000 in my 401k. The market's going crazy. I think I need to diversify some. Let's put some in real estate, right? What can you do? And then, but you look at them the same way. You're offering them a return on their funds, just like it would be on any kind of stock return, anything else, right? So that's one key thing I've realized. When you're talking to private lenders, you need to talk to them about their portfolio as a whole. So hey, we're giving you a way where you can kind of diversify your portfolio into real estate. That's what we offer, right? Yes, your stocks, your bonds are good, your crypto, your gold, all that stuff is good. But here's a way to diversify into real estate without being the landlord or the homeowner.
Okay, that's a very good point, because in having those conversations, they may move some money around to be able to do more deals when they see what the business model is, or when they see a return on investment, or when they do a couple deals with you, it goes well, and now they're thinking, what else can I liquidate to be able to keep this moving and do 3 more, 4 more, 10 more deals like this. So having that conversation leads to potentially other opportunities, because if they have it over in an IRA and it's making 4%, and with you they're making 8%, well, how do we liquidate that IRA and do a couple more deals?
Yeah, and that's how it usually goes, right? Usually a brand new investor is comfortable giving you a portion, right? They might say, hey, I have $1 million that I'm looking to diversify with. Maybe they'll give you $250 the first time, right? Then after a few months, hey, this looks good. They'll throw on maybe another $250, another $500,000, right? So they do want to see some kind of track record at first. You're not going to get that guy to give you his whole, allocation, right? But he'll give you a little bit. You do good by that, they'll keep adding on. I mean, we have guys right now that I know for a fact are moving money out of stocks, right? Just because, they have a lot of money. They've had a lot of money in stocks. They were able to run up the stock market, last year, and they're just kind of seeing a little bit of weakness in it, and they're moving money from stocks, right, into investing it with us to buy more properties.
100%. So now the rules of the game, the terms, that is where a lot of people get confused. This is where there's a lot of differentiating terms and options. at the end of the day, hard money and private money is not your typical bank conventional investor loan. So the rules can change. The rules are different. The terms 9 out of 10 times are negotiable. Um, it depends. I mean, someone like me, I may not negotiate what my credit box is, and it's not because I can't, it's because I choose not to. Or it depends. Maybe I have 10 investors and we've promised them XYZ type of deals. So I'm using, their money to run it through our institution, and we have our own credit box, and we need to honor our agreements, and we have a certain risk threshold. Um, with private money guys, if they are lending their own money, those tend to be a lot more flexible and you can negotiate. So the first thing you got to take away from this isn't a set cookie cutter situation. If you meet a hard money or a private money lender and they say you got to give me 50% down and I'll put in the rest, that doesn't mean that that's the way hard money or private money works across the board. If they say I'm going to lend it to you at 8%, that doesn't mean that all hard money is going to lend it to you at 8%. So being able to kind of have your 2 or 3 top people that you go to every time you need something, and then potentially building joint venture relationships with other people that are willing to partner with you and put their money, and you do everything, whether they want to know everything like Jay said earlier, or they're like, look, just give me my check per month and I'm good to go. We're more like a silent partner. Those relationships, you can build as many of those as you want. That happens. I mean, we talked about it 1,000 times in raising money. Those happen in just having those type of conversations of, what are they doing for retirement? What are they doing for passive income? And when you hear what people and their plans are and where they have investments, and you start talking to them about the type of deals that we're doing, that's when a lot of the times they start piquing interest and want to move their money around. Those you can have infinite relationships with. Now, having the right relationships makes life easier, less headaches, because the ones that want to know everything, sometimes it's okay, sometimes it's a pain in the ass.
Yeah, definitely. I mean, we have some lenders who are just like, hey, we need 50,000, we'll give you 12% and they'll just cut a check. They don't care about any properties, right? For the majority, our private lenders, they know what we do, but none of them are like where it's like, hey, here's the property, here's the address, here's the ARV, right? Our private lenders don't care about that. Our private lenders get an overlook of what we do as a company, right? They believe in the company, what we do, they believe in us, more importantly, and then we're good to go, right? And I would say that's the main difference probably between a private lender and a hard money lender, right? Where a hard money lender is going to want to see, they're more your asset-based lenders, where they say, hey, we don't really care about your credit score as much. We care about the property, because if you don't pay us, we get the property back, right? So that's the main thing with a hard money lender. Almost always, they're going to want to see the property details, where our private lenders just want to return, And it's also a way where, because think about it, they might loan us $250,000, right, today. And the way we do it is that might not be spent for 30 days, right? So I'm not calling them every time and say, hey, I'm using 25 for this and 75 for that house, right? They're loaning us $250. We're doing 2 things. We're paying a rate of return on the unused funds, right, which is a smaller rate. So until those funds are used, it's a smaller rate. Then when we use those funds, we're paying our 8 to 10 to 12% return, And that's how we set up with our private lenders. So it's not where, hey, we're calling them every day, I got to get 55,000 for this deal today, right? It's like, no, I'm going to loan you 250 at 10%, and here are the terms.
What's your typical rate that you pay for unused funds if they've already wired you the money, but you haven't put it in a property?
Right now, we're doing like basically what would be like a money market, right? So we're at like 2% is what we're saying we'll pay, right? So it's basically, hey, if we're going to hold it, it's going to be somewhere near the prime market money rate, and we're going to go off of that.
My private lenders, the relationships we've built is kind of like, are you interested? Yes. Can I have your commitment that when I call on you, you'll be ready to go? Yes. Obviously, I'm not going to sit on your commitment for 6 months and not send you anything because you're going to find somewhere else to put your money. But if we have this conversation and in 6 days or even 3 weeks, I call you and say, we got this deal, this is what it is, and you don't fund, that's okay. But realize that I'm probably not going to call you again and again and again and keep giving you opportunities if you keep passing. Maybe you pass for a significant reason. Maybe, it's all relationship. Hey, listen, I'm in the middle of something. I'll be liquid in a couple weeks. Skip me on this one. Come back to me in 3 weeks and I'll be liquid because I'll sell whatever, or I invested it, or I lent it somewhere else. All right, we have a line of communication. I got a couple of other people I can call. No big deal. I just personally don't like to collect money to just sit there. I don't like to have people's money. It just puts more pressure on me to have to place it. And I just like to say, all right, cool, Jory, you're in. You got about 300,000 available. Cool. And I'll call you over the next couple of weeks and let you know when we have opportunities for you. And if they're serious, when we call, they're like, all right, let me know, get what are the details, and then they fund it. Again, it just goes to what we're saying, no rules, no set way of doing it. It's just how you're able to create your relationships and your business model.
Yeah. It's what your lenders are comfortable with, the two you're comfortable with, right? So we use an escrow service for those funds to sit into until we go out and spend them, right? Another thing that we both will stress is you don't want to mix funds, right? When you're getting private money, anything, right? You don't want to mix funds. So you don't want to like say, hey, I'm gonna put Kevin's funds and Jory's funds and this other guy's funds into an account, right? That's a big no-no. Don't mix. I'm not saying that you can't use Kevin's funds and my funds to fund the deal, right? As long as they know about it. But you definitely don't want to commingle funds into one account and just have it all sitting in there, right? So you want to have escrow accounts for each lender you have. You want to have that separated, right? Because even you could be a little guy doing a couple of deals here a year, but if there's SEC guidelines when you're raising money that you don't even know about that you can fall under.
Yeah, definitely. When you're trying to peak interest, build relationships with people because that's really what they want. If it's a relationship, it's more like a partnership where if you're just posting on Facebook, I got a deal, I'll give you 10% return on $100,000. There you could start building legal issues because you're not licensed to essentially raise capital, and there's different laws that you got to follow. But if you build a relationship with people, if you show people, hey, if you're interested in partnering on a deal with potential of earning 10% on your money, let's talk. And then you have various conversations and you meet with them and you actually build a relationship and you can document that, then that's a little different. Some of the terms.
Yeah, let's get into some of the terms for sure.
Hard money is asset-based, meaning they care more about the property. Obviously, when they build relationship with a certain borrower that makes good decisions and keeps coming back, usually terms get better and better. That's why you want to go back to the people, because they might start you off at a certain interest rate and certain points. Points is percentages. So if you pay 2 points, that means you're paying 2% of usually the loan amount that you're borrowing. So you might pay 3 points the first deal you do with them. Then the second deal you may pay 2.5%. Then the third deal you may pay 2%. Depends how often and how frequent you're doing deals with them. They'll give you better terms. You might start off at a 13% interest rate, and as you keep bringing them business often, you might work your way down to 9%, 8%, 10%, something like that. So you save some money there. After repair value, ARV, that's a big term that they're going to constantly ask you for.
As is value, right? Sometimes they'll ask for the as is value.
Correct. So that's a big thing, because if you get in way over your head, or if you get popped by the city and you didn't plan to get the city involved, and now the city goes there and says, this whole half of the house was never permitted. This is all, illegal. It's not done correctly. And now you're looking into a major drama, and you're looking into money that you didn't have. And now this deal is just not going to make sense. And let's say you walk away from it literally without ever picking up a hammer or doing anything to it. And you just say, you know what? I'm out. The lender doesn't want to be in that for, if they got to sell it as is, what can they sell it for? And that's why they pay attention to as is value.
Yeah, definitely.
After repair value, as is value, construction draw or construction schedule, meaning what's the budget and how are you going to run your construction? We're going to paint, we're going to do floors, we're going to do kitchens, we're going to do bathrooms, we're going to, that's your construction schedule, what you're going to do, when you're going to do it, and how much is each going to cost you. That's a common term in the game. Private money, they're mostly asking for a return on investment. They care about the cash flow. They care about the security.
Yeah, secure. Yeah, having their, just so you know, when we're doing private money, usually we're going to do a note and mortgage with our private lender, and that note and mortgage will be secured by the property, right? So it's actually on the property. So their backup is, hey, if we default, you get the property back, right? It's secured by that.
Right.
A couple of terms.
Mortgage. That's a way to also protect them. So I have a lot of assignments of mortgage, because what if I have a heart attack, or what if I get on a plane and the plane goes down? What if I get in a car accident? And what if the money was lent to my corporation? What protects them if, let's say, I lend the money on a deal and I'm the bank on the deal, but Jory's really one of my investors? Jory might say, hey, listen, if something happens to you, how do I get my money back that I lent to you that then you put into this deal? Well, there's an assignment of mortgage that we both signed that gets recorded if I disappear. So he can then now step in and be the new bank. So that is, if on some of the creative financing deals, or when you're raising capital, depending on your partnership agreements, that's a popular creative technique that we get into in our creative financing trainings and in our partnerships. That is a common term, assignment of mortgage, meaning I'm assigning the loan over to someone else.
And be clear that, right, that's signed, but it's not recorded, right? So it's that's held with the title company, or it's held with an attorney, who then, if something would happen to Kevin, remember when he says investor, he's saying, hey, Kevin, I got 50 grand, go find a deal for this, right? I'm the investor, he's the lender. If something would happen to Kevin, that mortgage would transfer to me, so I can still collect and do whatever needs to be done as the investor.
Correct.
Some of the other terms you're hearing, so personal guarantee, right? A personal guarantee means, hey, right, I'm going to lend to the company, but some lenders may want a personal guarantee that says, if something goes wrong, if we can't get it from the company, we want to get it from you, right? That's what a personal guarantee is.
Yeah, and a lot of the times you're going to find people making sure you personally guarantee it because they want skin in the game. So they want your personal skin. Usually you're the one that's on your behind.
Yeah.
Just to make sure, hey, listen, put it on the line. Not putting my money on the line. Put your reputation, put your credit on the line, and we're in this together. And that's just how they look at it. If the deal's good and you have every intention in paying it back, then you sign the personal guarantee.
As an investor, we would love to not have personal guarantees, but again, as a lender, from a lender's point of view, I definitely want a personal guarantee. So it's the kind of tug and pull. And if they ask for it from us, we give it, right? Because we're giving you my word. I mean, there's no reason for me not to give it if I believe in my investment.
Correct. So loan to cost, right? There's loan to value, then there's loan to cost. Loan to cost is usually how much of a loan they're going to give to the cost of the property, the purchase price. So they might sit there and say, look, I'll loan to 75% of the value, and I'll do 80% loan to cost. And that's when sometimes it gets a little confusing, because you're like, wait a minute, what? And that's usually when you're looking for construction money and you're looking for money to buy the property. So if someone tells you loan to cost 80%, that means if the purchase price is 100,000, they're gonna want you to put 20% down. They're gonna give you the other 80%. So they're gonna give you 80,000 at the day of closing, and then they're gonna give you and then you're gonna put the other $20,000.
Yeah.
But they're willing to go 75% loan to value. So if you now have $100,000 worth of repair and the property's worth 420,000, that's a deal that right now me and Jay are working on. Well, then I'll give you the rest of the construction, 100% of the construction, as long as it doesn't pass 75% of the value. In this case, if I'm buying it for 100 and I need to borrow 100,000, an extra 100,000 for construction, and the property's worth 420, 430, 75% of that covers both the purchase price and the construction. So we can get a loan for essentially $180,000. The $80,000 to buy it at loan to cost, and then $100,000 for construction because it's under that 75% loan to value.
And then the buyer would have to bring that 20,000, right? The 20% of the 100,000 plus whatever closing costs of what they would bring, and then the deal would be able to close. Yep.
Right. And then the construction draw gets held by the private lender or by the hard money lender, those $100,000, and then you start working on the property based off your construction schedule. And as you go finishing things, the way you laid it out on the schedule and turned it into them, so they're going off your schedule, you call for inspection, an inspector goes out there and deems it either 100% complete or 80% complete or 50% complete. Usually we'll charge you in about $200, $250 for the inspection. And if it's 100% complete, they will fund you 100% of the money they were holding on so that you can recover from your construction draw what you put in out of your own pocket. You get that money now back to you. And then now you have more liquidity to go do either more renovations on the same property or go get another property while you're finishing the project and you're selling the house. Why is that important to negotiate those terms and be able to consider that? I just spoke to somebody yesterday that they got into a property pre-pandemic, right? Like March of last year. And they originally estimated 6 to 8 months between plans, permit, construction. Pandemic hit, they're selling now. So a year and a month later, they're under contract to sell to make a $60,000 profit. So their holding costs were an extra 5-6 months. Everything was a lot more time and money. They were able to get their construction money back and carry the holding cost. If they wouldn't have taken a construction draw and they would have just bought the property $80,000 $20,000 down, borrowed $80,000, and they would have used $100,000 of their own money to fix up the property, and they would have been in this situation. Well, then now it's taking longer for whatever reasons, the city, the plans, the permits. You had to fire the contractor, get a new contractor. There's 1,000 things that can go wrong.
Yeah, they had no cushion. They had no cushion to protect for that rainy day event that happened, right? So that construction loan allowed them to have the cash that they had to be used to cover them to get them through. That was huge. That was huge, definitely.
Yeah. So they got their construction money back, and then they were able to hold on. And now they're selling it to recuperate all their money back and making $60,000 on it. So luckily, they took the construction loan out. If not, they would have been in it for all their money, and they wouldn't have been able to hold on to it. Now they default on the mortgage payment. They lose the deal. they lose the relationship with the lender, and that's the name of the game here, guys.
Definitely. Yeah, you mess up once with a lender. I mean, that's the whole point, right? Like I think the key to that too, Kevin, is you're saying, hey, don't get your first deal. Definitely, right? Try to get a deal, lock it up. But they had some reserves. We always talk about reserves, right? Don't try to get a $300,000 loan with no reserves there, because holding costs are a big deal. When you buy that house, you still have to pay that mortgage per month. And if anything goes wrong, there's holding costs, right? Construction always goes over your planned budget. So in anything you do in real estate, try to have a little bit of reserves on the side to, take care of you for a rainy day.
Yeah, 100%. I think I've gone over every single construction budget that I've had.
I'm about to say, there's not one where you haven't. I mean, I never have. It's always gone over.
And sometimes substantially over. Look, I just finished one last week. I went over $6,000, and then I have one that I've gone over $30,000. Like it happens. The whole key here is mindset behind this, right? When you're dealing with private money, you want to be optimistic, and I understand that, but you're trying to, like, this guy still made $60,000 paying on the construction loan with the acquisition loan of it, the loan to cost and the construction. He still made $60,000. If he would have been trying to make, let's say, 80, and he would have said, no, I'm not going to take the construction loan because I want my loan amount to be less, because I don't want to pay the holding costs, and I'm going to roll the dice and I'm going to put all my money into it. And then he runs out of money to be able to hold on to it and loses the deal, all because he wanted to squeeze 80 out of 60.
Yeah.
When I go over my budgets, this $30,000 one, the $6,000 one, this and that, I'm good no matter what, right? Because the deal, I'm good. I don't put myself in a position that no matter how good or how bad it goes, I'm going to be eliminated out of the game. Like, I make sure that I'm covered, that best case scenario or worst case scenario, I'm still good in the deal.
Yeah. We talk about it a lot. You never do a rehab flip and your only exit strategy is flip. That's all you can bank on, because if something happens with that, you're stuck, right? So every deal, look at it and say, okay, if this doesn't happen, can I still, everyone we do, right, Kevin? I can still rent this house out and make, at least cover my payment, or make a couple $100 if I need to, right? That's just the way we're buying it. We're never going to buy a deal where if I can't flip it for this, I'm just stuck with a deal. That's a bad deal.
Right. And we got a couple questions. Joe's asking us, how do you set up escrow for just funds for private money?
So you can go through your title company, right, or your attorney, right? Title companies and attorneys do it. So our title company will set up an escrow for each individual lender that we have, and then we'll just call them to release the funds, right? So title companies, attorneys will do the same thing. If you have a good relationship with a title company, they'll probably do it for cheaper than your attorney will. But both, you can do both avenues.
We got Real Estate with Bills asking, is that the same for a rental deal? Like if you got a buy and hold deal. So for a buy and hold, there is longer term private money deals. Like we got a really strong 30-year option, and we'll go off of after repair value without making you be the owner for a year, like most traditional investment loans on the conventional or portfolio side. But we don't allow renovations on those deals. So what a lot of people do on the BRRRR strategy is they'll first buy it with a bridge loan or a fix and flip loan, do the construction and all that, like we just talked about. And then that usually you get about a year to 2 years max on that. And then you'll refi it into one of these longer term 30 years. Once it's already fixed up, you got it rented. The value now is a lot higher because you fixed it up and you got it rented. And then you can go off the appraised value into some of these longer term. And what they care is still asset based, right? How good of a job did you do on the renovation? What's it worth right now? And what do you have it rented? We do right now, post-pandemic, look at credit to make sure that the pandemic hasn't screwed you and you haven't if you haven't made any payments on your credit lines and on your mortgages, then credit matters, because it's obvious you're being affected financially with the pandemic, and now you're trying to do a deal. That's not going to make a lender very comfortable. So we do look at credit, but we mostly care on the buy and hold deals, what the value is, and what do you have it rented for.
Definitely.
And that term we call debt service coverage ratio. So does it cover the debt? Essentially, that's what debt service coverage ratio means. So 1-to-1 or more, meaning if my mortgage is 1,000, am I rented to at least 1,000 or more? Or am I under 1,000? If you rented it for $800 and your mortgage is 1,000, now you got to pay $200 out of pocket. Now you're going to be scrutinized a lot more, because do you have that money? Can you afford that? Does this deal even make sense? Why are you paying $200 out of pocket? Oh, because the value is going to go up, or whatever the plan is. We got to hear it, because it just doesn't make sense to get into a property that doesn't cash flow.
That's good stuff.
We got real estate with Bill. Where do I go to get info? You can reach out to us, myself and Jory. Let us know which private loans you need. We got a lot of our network that listen to us that are submitting deals, and we're offering private money terms. So that's the benefit too, guys, of being part of the Shut Up and Invest family. Join the Facebook group. We fund your deals. Send us your deals. If you're looking for private money, we'll go ahead and take a look at it, and we'll see if it makes sense. And you guys want to look at hard money loan terms I was just sent? Yeah, of course, 100%.
I think that's Chris. We can't see his name, but he did send me some hard money terms a few days ago that I looked at. So if that's Chris, let us know. I can't see your name; it just says Facebook user.
Yeah, make sure you guys connect your Facebook if you're on the Facebook, so that way we can see who you are. Send us your hard money loan terms. We'll look at it. We'll look at the property. We'll see if we can help you guys out there as well. Joe's asking, have any of you lost a lender? Very good question.
That is. I never lost a lender. I mean, some of your lenders kind of phase out, right? Where they've made their money in whatever cycle they wanted to do, then they kind of move on. But as far as losing a lender, no. I mean, let's when you get a lender, especially a good lender, right? You do everything you can to take care of that lender, right? So like when you have your lenders that you're doing deals with, they come first, right? Our bottom line matters, but if we have to take a sacrifice to make sure our lender gets paid, we're going to do that, So always put your lenders first.
Yeah. Losing a lender can happen out of your control, right? They might get out of the game. They might have lent all their money out, so now they're waiting to get paid back before they jump in. They might be getting divorced. Like, there's just so many things that can affect that. So it's not always on you and what you did, right? It's just life circumstances, business models change. So, or they might just retire and get out of the game. So a lot of those changes happen often. There's a lot of guys that were lending money 4 or 5 years ago that they're not lending money right now for different reasons. There's a guy that just finished pitching me, which I don't understand. Like, just called me, hey, here's what we can do, and like, as partner, and I know you have a large network, and let's do this and let's do that. And we got lines of credit, and it'll be amazing. And all right, cool. So after the pitch, hey, you mentioned the lines of credit, this and that. I actually have a couple of people interested. So, right now we're not doing the lines of credit. Like, okay. So what are you doing? Well, right now we're not doing anything. Like, why did you pitch me? Like, get back in the game, call me, and once you're ready to go, then you pitch me. But if you're not ready to go, why did you call me and waste my time?
Yeah, wasting my time. Yeah.
So then at that point,
that's another problem, Kev. I mean, make sure that you vet your lenders too, right? I mean, make sure that your lenders are going to do what they say they're going to do, because you have someone who says, hey, I commit to 250 in 2 weeks. You got deals you're locking up, waiting for that 250, and it doesn't show up, right? You're in a situation. So make sure that your lenders are vetted. And if it's a new lender, don't go spending that money until that money's in your account, right? So
that's the dangerous part about private money. I'm glad you brought that up. You guys it's a trust factor on both ends, because if they say, oh yeah, you know what, I'm interested, but they're really pulling your chain and they're really not going to fund that deal, or they're just giving you like yeah, that sounds good, let me know, and you're putting a deposit down, non-refundable contract, and you're like, hey, I'm going to do this deal, and you're promising and you're building relationships with the people involved in the deal and saying I'm in, and then that person doesn't come through with the money.
Yep, you're tough. You're definitely tough. So, we have some lenders who, if they say it's coming in a week, it'll be in a week, right? I can trust them. We have other ones who they could be a first time, you don't know. So I'm not going to go out there and put my name on the line with a lender who I don't know is going to, commit to the role. So make sure that you're, because there's a lot of, again, end of the day, this is a relationship business, right? It's a relationship between you and the seller, you and your buyers, you and your lenders, title companies. Everybody's in this together, as relationships. So make sure you're doing right by those.
Yeah. All right, Jay. I think we covered a lot, and we kind of gave the 101 on the differences between private money and hard money and some of the different ways to look at it. If you guys have any questions, if you guys are dealing with private money, if you want us to look at it, we'll tell you. Listen, there's plenty of times that I'm like, that's a great deal. Take it. If they're really going to give you the money that cheap, like I have, what was it you, Jay, that I was talking to, or someone else? Oh, no, I think one of my other guys. They're going to give 95% of the money. They only got to put 5% down. First time ever investor, 8% interest rate, pays 1 point.
No, you didn't tell me that yet.
Right. They're going to only make that brand new investor who's never done a deal before, only put 5% down, is paying 8% interest rate, and they're only charging them 1 point. Sounds amazing. Go for it.
Yeah. Yeah, definitely. If you get that, take it.
Yeah. Last question, and we'll end with this. How do you get a hard money loan to do 100% funding? Hard money lender. Very good question. I've extended 100% to a couple people. It's very simple. Offer them a percentage in the deal. Offer them a joint venture option, because if they're just going to lend the money and you're just trying to pay them 8, 10, 12% on their money with no skin in the game, number one, you got to make them a lot of money first, right? Most of the time, unless you find someone crazy enough that'll give you 100%. And I'm not saying they're not out there, but the ones that do just aren't experienced enough to know better. So that might be to your advantage.
Yeah. And I would say that, and there's a key distinction. He said hard money lender, right? Because our private lenders are all 100%. Everyone I have is 100%, right? Because again, they're just loaning for a return. They're not loaning per property, right? The hard money lender is a little bit more difficult. So, but what Kevin said is true. I mean, to say, hey, I have a deal. Here's the deal. Here's the situation. I need $100,000. If you give me the $100,000, you get a piece of the deal. Plus, I'll pay the interest rate, right? And that's an easy way to usually get 100%.
Yeah. Or do a couple deals, put skin in the game, make money, show them that you're responsible, show them that you pick good deals, show them that you bring them business, show them that you're loyal, and start having the discussions of, hey, how can I get better terms? Is there a way that we could work something out to get 100%? And see what they say. They may not even ask for a lot.
Yep. Just ask, right? It always starts with asking, right? And that should be the answer. Any question, how do you? Just ask and see what they say.
Exactly.
Right, so
cool, all right, guys. Good show.
Definitely. We will. I see Chris had a question about the website, Kevin. That's the one who was trying to go into the link. It was getting an error. So I think we're working on that. And
I'm glad you reminded me. I gotta follow up with that because that, funny enough, it was happening, I think, on Androids. But
see, there goes the Android hate again.
iPhone, because it was working perfectly on my phone. Well, I don't understand what the problem is, but yeah, we'll look into that. And we'll message you directly.
All right, cool. All right, guys. Hey, once again, thanks for coming out. Thanks for joining. Like, subscribe, share the podcast, keep spreading the knowledge. And as always, shut up and invest.